The clock is ticking towards 2026, and with uncertainty in the economy and plenty of noise in the markets, many investors are asking a simple question: which Canadian stocks are worth buying now to hold through the next couple of years? In today's video, we're covering 10 of the best Canadian stocks to buy before 2026. These are companies with strong fundamentals, competitive advantages, and the ability to keep delivering growth or steady income no matter what the market throws at them. If you enjoy videos that break down investing in plain language, don't forget to hit the like button and subscribe to Bucks and Beyond so you don't miss the next one. Let's jump right in. We'll start with Brookfield Renewable, one of the world's largest publicly traded renewable power platforms. This company owns and operates hydroelectric dams, solar farms, wind projects, and energy storage across North America, South America, Europe, and Asia. Renewable energy is one of the biggest megatrends for the next decade, and Brookfield has scale and expertise to benefit. What makes Brookfield unique is its ability to recycle capital. It builds or buys projects, runs them efficiently, and then sells mature assets to reinvest in higher return opportunities. The stock currently offers a dividend yield around 6%, paid quarterly, and management has a long track record of annual dividend increases. For investors who want exposure to green energy transition, Brookfield Renewable is a solid long-term buy before 2026. Next up is Canadian National Railway. CNR might not make headlines like tech companies do, but it is a backbone of the Canadian economy. Rail is one of the most efficient ways to move goods, and CN's network stretches across Canada down into the US, connecting 3 different coasts. This reach gives it a competitive moat that no competitor can easily replicate. CNR ships everything from grain and coal to intermodal containers and manufactured goods. That means when global trade grows, CN benefits. Even in tough times, the railway remains essential because supply chains can't function without them. The company has increased its dividend for more than 2 decades, currently yielding about 2%, and it generates steady free cash flow. For investors looking for a defensive compounder heading into 2026, CNR is a must-own. In 8th place, we have Dollarama, Canada's largest discount retailer. With over 1,600 stores across the country, Dollarama has become a go-to destination for affordable household items, snacks, and seasonal goods. What makes Dollarama so appealing to investors is how well it performs during inflationary or uncertain times. When consumers tighten their budgets, many actually shop at Dollarama more often. Beyond Canada, Dollarama has also expanded internationally through its stake in Dollar City, a Latin American discount retailer. This gives the company growth outside the Canadian market, where it still has room to expand but faces more saturation. Dollarama doesn't pay a big dividend, but it makes up for that with consistent earnings growth. Heading into 2026, this is a defensive growth stock that can thrive in multiple economic environments. At number 7, we have Manulife, one of the largest insurance and wealth management companies in Canada. Manulife sells life insurance, health insurance, retirement products, and wealth solutions not just in Canada, but across Asia and the United States. In fact, one of its strongest growth markets right now is Asia, where rising incomes are driving demand for financial protection and saving products. Insurance may seem boring, but it's incredibly profitable. Once a customer signs up, these contracts generate steady long-term cash flow. Manulife currently yields about 4% in dividends, paid quarterly, and the company has been focused on cost-cutting, digitization, and expanding its footprint in Asia to fuel growth. For investors seeking both income and growth potential, Manulife is a smart choice before 2026. Energy remains one of Canada's most important industries, and Canadian Natural Resources is one of best-run companies in the space. CNQ is one of the largest oil and gas producers in the country, with a diverse portfolio that includes oil sands, conventional oil, and natural gas. What sets CNQ apart is its focus on cost efficiency and disciplined capital allocation. Even when oil prices are low, CNQ can still generate strong profits, and when oil prices are higher, the company pours excess cash into dividends and share buybacks. CNQ currently offers a dividend yield around 5%, and management has consistently raised payouts for years. While the global energy transition is underway, oil demand isn't disappearing anytime soon, and CNQ is positioned to keep producing strong cash flows well into 2026 and beyond. Coming in at number 5, we have Shopify, Canada's most famous tech company. Shopify powers online stores for millions of merchants worldwide, providing everything from payment processing to inventory management and shipping solutions. During the pandemic, Shopify exploded in growth as small businesses rushed online. But after the bubble burst, the company has been working hard to build a more sustainable and profitable business model. Now, Shopify is focusing on scaling its merchant services, building stronger partnerships with payment providers, and expanding globally. The company isn't a dividend payer, but its growth story remains intact. e-commerce still only makes up a fraction of total retail sales worldwide, meaning there's plenty of runway left. By 2026, Shopify could be in a much stronger position, especially if it continues to innovate and expand internationally. In fourth place is TELUS, one of Canada's three major telecom giants. TELUS makes money from its wireless, internet, and TV services. But what makes it stand out from rivals is its push into new businesses like TELUS Health and TELUS International. TELUS Health is a digital health platform that provides virtual care, pharmacy solutions, and healthcare data services. As healthcare systems digitize, this side of business could become a major growth driver. TELUS currently yields about 7% paid quarterly, making it one of the highest yielding blue chip stocks in Canada. While telecom companies carry a lot of debt, their services are essential. Data demand is growing every year, and TELUS's diversification makes it more than just a phone company. For both stable income and long-term growth potential, TELUS is a great pickup before 2026. Now, let's talk about a hidden Canadian gem, Constellation Software. Unlike Shopify, Constellation Software isn't about flashy growth. Instead, it quietly buys small niche software businesses that most people have never heard of. These companies often provide mission-critical software for industries like healthcare, municipal services, or logistics. Because the customer relies so heavily on their products, these businesses generate steady recurring revenue. Constellation's strategy is simple: acquire these businesses, improve operation, and let them keep producing cash. Over the years, this model has turned Constellation in one of the best performing stocks in Canada, with a history of compounding shareholder wealth. The company doesn't pay a significant dividend, but it reinvests heavily into new acquisitions. Going into 2026, Constellation's pipeline of opportunities looks just as strong as ever. Canadian banks are legendary for their stability, and Bank of Montreal stands out as one of the strongest. With over 200 years of history, BMO has weathered every financial storm, from recession to global crisis. Today, what makes BMO attractive is its expansion into the US through its acquisition of Bank of the West. This move gives it a large footprint south of the border, opening up a bigger growth market. BMO currently offers a dividend yield around 3%, paid quarterly, and Canadian banks have some of the longest dividend-paying histories in the world. They are highly regulated, but that stability is what makes them so dependable. Heading into 2026, BMO offers investors a blend of income, stability, and international growth. And finally, our top pick is Brookfield Asset Management. While Brookfield Renewable focuses on green energy, BAM is the parent company that manages money across infrastructure, real estate, renewable energy, private equity, and credit. In total, Brookfield oversees more than $1 trillion in assets, and it earns management fees and performance fees on that capital. What makes BAM so compelling is scalability. The more assets it manages, the more fees it collects. And as institutional investors continue shifting money into private markets, Brookfield is one of the biggest beneficiaries. On top of that, Brookfield has decades of experience running and growing real assets, giving it a reputation as one of the best in the business. The stock yields about 3%, but the real story is the compounding power of fee-based income. By 2026, Brookfield Asset Management could be even bigger, making it the best Canadian stocks to buy right now. So there you have it, 10 Canadian stocks to buy before 2026. We've covered renewable energy, tech, banks, telecoms, and more. A mix of income and growth names that together form a strong portfolio heading into the future. Which of these companies do you think has the most upside over the next 2 years? Drop your thoughts in the comments below. I would love to hear what you're buying. If you found this breakdown useful, don't forget to like the video and subscribe to Bucks and Beyond for more deep dives into Canadian and US stocks. Thanks for watching, and I'll see you in the next one.